Hello, it's Big Chads, and this is the Trading Encyclopedia Daily Education series on my YouTube at Chads Trading. You can find me on Twitter at Big Chads and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about the idea of a market order. We've covered limit orders before, trailing stop, a whole bunch of stuff about a market order. And you probably know what it is, but it's important, I think, to have a good reference. And so market order, here's just an AI overview. It talks about speed over price. And you're saying, I want it now, or I want to sell it now. So let's take a look. Market order versus limit order. So for example, I want to buy some juice and the juice costs $5. You just buy it at whatever the price is. Price is $5. As opposed to, well, I'd like to buy it if it, becomes $4 at some point. That's a limit order. Now you see here, oh, the juice costs $5. I want to buy it, right? There's a lot of problems with market orders, right? Because you're subject to the liquidity in the pool that you're trying to buy it from. So there's something called slippage. So let's go back here, and it talks about some dangers, risks, slippage. So let's say, there may not be enough liquidity at $5, right? Say you want to buy 1,000 units, and it's, oh yeah, I can buy it at $5, but there's only 3 units available. Maybe the rest are available at $6. So you go to market order, and what happens is the market maker fills your order at 6. Even though you thought it was 5, I hit market order. That is slippage. The final execution price is different than the price when you saw placing the order, especially in volatile markets, thinly traded markets. You see this a lot, like in penny stock markets, or especially in the crypto field where many of my friends are, where you think you're buying it at a certain price, and then when you hit the market order, you're subject to the market maker's whims, right? Again, rather than a limit order, at a specific price. So let's say you have it split up this way. This is the the orange juice one. So the ask means people who are selling are willing to sell it at $5.50, right? People want to buy it; they want to buy it at $5.50, at $4.50. The midpoint's $5. You go, I want to hit market. Boom, you hit the ask, rather than the bid price to sell. You're subject to whatever the ask price is, whatever the next available seller is at that price. And if you exhaust all the orange juice or whatever available at $5.50, you're going to start paying $6.57. So and same thing for selling. I want to get out. I want to get out immediately. Well, you may not get out at the price you're thinking you're going to get out at. You want to be really careful with market orders. That's why limit orders make more sense. You're saying, I want to buy or sell at this price. This is what I think it's worth. And so you just be incredibly careful with market orders. There's a lot of danger to using them. You can read this again on your own time. But this is the general, really quick overview on the idea of what a market order is. For the Trading Encyclopedia Daily Education series on my YouTube, Chads Trading. Find me on Twitter at Big Chads and Bitcoin Live, where I'm a founding analyst. Folks, thank you so much, and I'll talk to you soon. Big Chads out.